Hi, my name is Jordan Wilson. Today we're going to look at whether you can utilize a buy and hold investment strategy using non-diversified assets. And by non-diversified, we're talking individual stocks, bonds, kind of what you buy through your broker if you're not buying a mutual fund or an ETF. So is buy and hold possible? Feasible? If you invest in individual stocks and bonds. It is possible. Investors can create diversified portfolios and utilize a buy and hold strategy with individual stocks and bonds. In fact, there's many hold forever quality holdings out there. Warren Buffett is quite famous for his belief in the long-term viability of Coca-Cola. Walt Disney Company, there's another. Today, we would probably say Amazon, Google. You buy the shares, you throw them in your account, and you forget about them and live off the future capital growth and any dividends that are issued. Now, to me, the bigger question becomes, you can create a diversified portfolio, but can you create a well-diversified portfolio? And when we looked way back when at diversification, we talked about how many investments do you need to properly diversify? And that diversification was to eliminate the stock-specific, non-systematic investment risks and to try to smooth out some of the systematic risk. I think if you are very efficient, you may be able to create adequate diversification with maybe 30 stocks, maybe 10 to 15 different bonds. So in a best case scenario, you might be able to create a well-diversified portfolio with under 50 holdings. Now the reality is that it probably needs to be more. Because if we say 30 stocks, well, I live in Canada. I probably want a couple of Canadian companies in my portfolio. I definitely want some US stocks because the US is, roughly 50% of global equity markets. So I need exposure there. I need some exposure to Europe, to Asia. And then do I need exposure to small caps, mid caps? Because if I'm investing in the Amazons or the Googles, those will be the mega cap stocks. What about if I want industry exposure, natural resources or industrials? Maybe I like environmental, social, governance, the ESG stocks. Maybe I want to invest in high tech, let's say Tesla. So the more that you want to diversify across geography, market capitalization, industries or sectors, the more you're going to have to add to your portfolio. Unless you go out and say buy a company like Berkshire Hathaway, which has its fingers in many pies. So from a practical side, becoming well diversified necessitates substantially more holdings than 30 to 50. And I think the key to adequate diversification is that you need to be well funded. You need to have a critical mass of investment capital. And that number you can't just say is going to be 100,000, 500,000, because it depends on how many different pies you want to stick your fingers into. And I don't think it's an issue to invest in individual assets if you do have that critical mass, because you're essentially creating your own diversified mutual fund without paying anyone else for that. So you can do it. You just need to figure out a critical mass of money so that you can diversify and not get chewed up trying to buy $100 at a time when A, you may not be able to buy a share of Amazon or Google at $100, and B, it'll take forever to diversify with small amounts. So possible, yes. Practical, maybe not. The other thing you need to factor in, which again requires that critical mass of assets, are your investment costs. So if I'm maintaining a portfolio of 50 different investments, I'm going to have transaction costs, even a buy and hold. That's one cost. 50 different companies or equities plus bonds. That's going to require accounting, tax. So there's going to be costs to maintain and monitor and deal with the portfolio. And then there's that opportunity cost. Now, if I want to go out and hold 50 different stocks in my equity side, hopefully I want to find best-in-class assets. So I need to do research in each asset class and subclass to find the best quality investment. And then I need to monitor that on an ongoing basis and compare that asset against opportunities down the road that come along. So there's a cost in time and money to monitor and maintain a portfolio of non-diversified assets. So is it possible? Yes. Is it prudent for most people, even if you have, say, $1.5–2 million in assets, that you could create a diversified portfolio? The answer is probably no, unless you're willing to pay a cost to outsource that monitoring and assessments and rebalancing as needed to a professional investment advisor, whether that be an individual or, again, if you hand your money off to Scotiabank in a managed portfolio. So you're outsourcing the actual investments. The other problem, or another problem to me, with investing in individual assets is quality changes over time. These hold forever stocks, Coca-Cola, Walt Disney, yeah, they've done well. They've lasted the test of time so far. But I remember, in the same breath as Coca-Cola and Walt Disney, General Electric, General Motors, Eastman Kodak, Lehman Brothers. Those two were buy and hold forever equities. GE had huge struggles over time, and they used to be the Rock of Gibraltar. Eastman Kodak, I've mentioned that one before. In the 1970s, they had 85 and 90% market share in their two dominant markets. By 2004, they were taken off the Dow Jones Industrial Average, an index that they had been added to in 1930. So they lasted 74 years as one of the perceived top 30 companies in the United States. 2012, they filed for bankruptcy. Then we look at Enron, which was also considered a fantastic company. And I think most of us know what happened to Enron. Nortel. It dwarfed pretty much every other company on the TSX 300. Gone. WorldCom, another huge bankruptcy. So the quality within a company, that non-systematic risk, the stock-specific risk, management, operational, legal issues. Lehman Brothers got caught up in the subprime mortgage problems. Enron, creative accounting, if we put it that way. Kodak just wasn't able to react in a business model as the world changed. It was like the horse and buggy companies when the automobiles came along. So what's quality today may not be quality tomorrow because of the inherent risk factors in any specific company, the non-systematic / stock-specific risks. So I'm not sure about the hold forever side. And it'll be interesting in the future because Coca-Cola would be a good example. They have moved into other business lines. Dasani Water would be an example. But the world is almost getting to the point where we're treating sugary soft drinks as we did tobacco industry. So can they be nimble enough to adapt their product lines or find new markets where it's not an issue to maintain its competitive advantage and its long-term viability? So those are issues. Another problem with investing in non-diversified assets is that the world changes. And I'm not sure I'd call this the systematic risks, but close enough. The world is constantly changing. And if I look at the S&P 500, the top 10 holdings as far as market capitalization goes: Apple Computer. Now, Apple was plus or minus almost bankrupt in the mid-90s. And then they brought Steve Jobs back, started creating new products, and turned their fortunes around. But in 1997, they were a relatively dead company, one that you may not invest in unless you had a lot of foresight or a lot of luck. Amazon. It went public in 97, and it survived the dot-com crash. Many similar companies to Amazon did not. And if you look back to Amazon at that time, I mean, they were just basically a online book vendor. They hadn't really evolved into where they are today. So 97. Google, IPO in 2004. Tesla, 2010. Facebook, 2012. Out of the top 10 holdings on the S&P 500, Only Microsoft, which did theirs in 1988, is earlier than 1990. And then you have two other companies, JP Morgan Chase, which technically JP Morgan Chase came into existence in 2000, but I will say they've been around for a lot longer. So that's an old guard company and probably one of those buy and hold forever, as is Johnson & Johnson, which, like Eastman Kodak, was created in the 1800s. Like 1896 rings a bell. So out of the top 10 holdings on the S&P 500, two of them are old guard. Microsoft was late 80s. But the rest, under 25 years that they have been publicly traded or have done their IPOs. So the world is changing. Pre-2000, much different landscape for what dominated the Dow 30 and what dominated the S&P 500. If we look at Kodak, as I said, 85 to 90% market share. They couldn't adapt to the growing world. So we see them in 2004 leaving the Dow 30 after 74 years. In 2015, Apple, which was a penny stock not that long before, in 2015, they're now suddenly one of the top 30 companies in the US. And that's because they took advantage of the new technology, the iPods, the iPhones, all these things that companies like Kodak didn't make an effective move into. Similar, Blockbuster video. If you're of a certain age, you went to Blockbuster a lot. That's where you got your video entertainment. They had the opportunity in the early 2000s to purchase Netflix that was just starting out. They declined. They didn't read the market correctly. Blockbuster bankrupt. Netflix hugely dominant. Yet at the same time, if we look at Netflix right now, they're seeing their market share erode because of offerings like the Disney, Amazon. So the question is, we went from Kodak camera to Apple iPhone cameras and Samsung and so on and so forth. Where are we going to be in 2040? Blockbuster to Netflix. What's next? So, again, I'm not sure that these companies that are dominant now, that people may think are forever stocks, is a guarantee that they will be around. And I think, if you look at, say, Tesla, relatively small auto manufacturer as far as production and sales goes, but their market capitalization, you'd think they were literally the biggest car maker in the world as far as production goes. Is that the future? Maybe, maybe not. But I do think there will be a shift to electric vehicles or hybrids, probably more on a cost-effective basis. And will the Toyotas, the Nissans, the General Motors, the Fords, will they be able to adapt to that? And that's the question. And that's the problem with investing in non-diversified assets. If I invest in the auto industry in a mutual fund, I'm hedging my bets. I may not get the full exposure to Tesla, but if Nissan comes along with a better offering, I have exposure there. If I make that full bet on Tesla, as people did on Blockbuster Video or Eastman Kodak, they might be finding their shares worthless. So that's kind of the problem to me with investing in non-diversified assets. If you have a critical mass, great. And if you have the support of a professional advisor or tax accountant or somebody who can help you manage that portfolio, also fine, because it will be cost effective. You can get what you want. I just don't think that in the long run, you probably want to do a buy and hold because the world keeps changing and companies keep changing. So buy and hold is probably much better for diversified investments like index funds, where you have 500 companies in the S&P 500. And as I've said before, the reality is you've probably got 20 to 40 companies as far as impact goes. It's not all 500 equal. But it's better than investing in one company and taking that full stock-specific risk. So I think that's all we wanted to talk about today. And I thank you for the time, and we'll be back with another look at buy and hold issues in the follow-up episode. Thanks again. Have yourself a good day.